US inflation shows its wonkiness, RBI opens door for rate cuts, and why there's absolutely no stopping Nvidia. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. We are at episode 102, and we are recording it from my office here at Brunel Business School. So this is where normally from now on, now that I am on, now that the show is on YouTube, you'll be able to see where see my face, see the location. Location is my office, essentially. So, lots to talk about, guys, because we are nearly 3 weeks away, only 3 weeks away from what I call the event of the year. And it's even though it happens in November, long wait, and the wait is nearly over. And the event of the year is nothing but US elections. And ahead of that, we got the final CPI report, the final inflation report in the US. That is the final CPI report before the US elections. And unfortunately, inflation did prove that it can be very wonky. What was supposed to be a pretty straightforward report was not so straightforward after all. However, markets being markets simply brushed it off and ended with yet another record-setting week. Once the dust had settled, the S&P 500 ended above the 5,800 mark for the first time ever. And the Dow is fast approaching the 43,000 mark. It's a milestone, nonetheless, whenever it hits. And something tells me we're not too far off from hitting that. In a record week, all three indices ended in the green, with the Dow up 1.2%, S&P 500 jumping 1.1%, and the tech-heavy NASDAQ also jumping the same amount, which is 1.1%. So, we're going to straight dig into the inflation report. And unlike there's a background noise, I'll be drinking some water, guys, because that means the moment I take a sip of water, it means that we're going to head into our first segment, Doctor's Weekly Snapshot. Sip of water taken. We are in the first segment. Now the question is, were we too early to declare victory over inflation? That was the question that I'm not asking you guys alone, but that was the question which was asked by the September inflation report. It threw a spanner in the works of the investor mindset. Everybody was expecting inflation to now, pretty much not be in the news anyway, because the Fed was too busy focusing on the labor market. But inflation did say that here I am, don't ignore me. That's what's happened. The good news, inflation has a two handle. Okay, fantastic. We wanted the two handle because the Fed's target is 2%. So we got a two handle. That's fabulous. Bad news, inflation came in hotter than expected, implying that it does appear to be stickier than initially expected. So the question that you as an investor needs to ask is, are you a glass half full kind of investor, or are you a glass half empty kind of investor? That's because it's positive to take from the report, negative to take from the report. It all depends on where you focus. That's exactly, that's the question, because like I said, it was not a very straightforward inflation report. First, as always, let's dig into the specifics. Let's dig into the specifics of the inflation report before I talk what it means, what it means for the markets. CPI rose 2.4% year over year. Like I said, two handle, fantastic. After rising 2.5% in August. So again, month over month, fantastic. However, while this meant that inflation has cooled to a new 3-year low, which is fantastic news, it came in slightly above the economists' expectations of a 2.3%. So we got 2.4. Economists were expecting 2.3, which means that it's a bit sticky. However, it has been cooled. The inflation levels currently are at a 3-year low. So that's good. Like I said at the start, are you glass half full, glass half empty? Choice is yours. And depending on that, so does your investment thesis. Core inflation, which is what you get when you strip out food and energy prices, which tend to be more volatile. Core inflation came in at about 3.3% year over year, higher than the 3.2% year over year figure in August, and also higher than expectations. What is especially worrying for economists, and more importantly the Fed, is that inflation has taken a very uneven path forward. And when I say forward, I meant downward. Like since it got into the right trajectory, it was steaming, full guns, it was basically foot on the pedal, foot on the gas pedal. It was rolling on towards exactly the Fed's target of 2%. But as it went down from the 8s and the 7s and the 6s and the 5s and the 4s and the 3s, now as we get closer to the target, it has suddenly become a lot wonkier than what investors would like, and more importantly, what the Fed would like. I mean, the path has become more uneven and unstable, with some months hot, some months cool. So you really don't know what you get from the price report. When you do dig a little deeper, then you will find that the perpetrators of the hot inflation report are different to the ones you saw in August. Again, giving way to more uncertainty. For instance, if August inflation was primarily driven by a big jump in house prices, then in September it was a combination of apparel, car insurance, airfares, and food inflation. The last of which, the food inflation, posted its biggest monthly gain since January. Housing prices, which were the sort of the drivers of the August inflation, actually cooled significantly in September, and so did gasoline prices, which actually was down 4.1% month over month, bringing some much needed relief for US consumers. The US has now reached a place where gasoline prices are the cheapest that they have ever seen after adjusting for income in the modern era. So, fantastic news if you're a US consumer. They tend to drive a lot there, and basically, in 2022, if you could recall correctly, gas prices were absolutely going in the wrong direction, and the Russia-Ukraine war didn't help either. But today, as we record this show, US inflation, the gasoline prices has now reached a place which is the lowest in the modern era. Fantastic. Now, see, great news on the gasoline front. Not so great news in terms of food inflation and apparel and car insurance and so on. See, therein lies the problem. You really cannot predict the driver of inflation anymore. If you could have done that, then the focus would have been to control the specific area, which has been the constant driver of inflation. So, for instance, if it was housing prices, then we know at a certain point in time you could predict the housing prices would go down, and because they are the only driving factor, you could actually forecast your inflation print a lot better. Problem is, you cannot predict what is going to cause what is the main driver of inflation from one month to the next. It's very difficult to do that. So you can't come to any sort of concrete conclusion that inflation is definitely heading in the right direction, and that at a certain point in time, inflation should hit that elusive 2% number. It has become extremely difficult to predict. If you recall correctly, when it comes to India, when it comes to gauging India's inflation, one could clearly see that it's food prices, which have been the constant drivers of inflation. I've talked about it time and time again. But in the US, it has been such a wonky ride that economists and, more importantly, Fed officials simply can't pinpoint to one particular source. To make matters even more complicated, the producer price index data, which was released on Friday, painted a completely different picture altogether. PPI was actually unchanged in September compared to August, confounding economists once again. They were actually predicting a 0.1% rise. They were expecting a 0.1% rise, anything but. A 0.2% increase in producer prices was clearly offset by a 0.2% decline in goods prices. So net zero, unchanged. Again, confounding economists, confounding Fed officials, confounding investors. So you had a Thursday CPI print, hotter than expected. Friday PPI print, not so hotter, in fact, unchanged, and actually coming in cooler than expected. Now, this is where you literally need to, basically tear your hair out. Please don't do that. But therein lies the problem. The positive here is that the PPI is a key data source for the Fed's preferred inflation gauge, which is the PCE index, the Personal Consumer Expenditures Index, which you will actually get on August 31st, Halloween boo. Okay, this means that the September PCE figure, again, like I said, set to be released during Halloween, boo, would most likely show a much better reading than the CPI print, and is unlikely, keyword unlikely, I can't say it for certainty, to spook investors and Fed officials, definitely pun intended. Okay. The CPI sources also affect the PCE metric, but the PPI items do have a significant role to play. And keep in mind that the Fed's decision on rate cuts is based on the PCE and not the CPI. And basically, I've put the metaphorical academic hat onwards in one of the episodes, explained to you guys the difference between PCE and CPI. I'm not going to go into an academic class now, but, so keep in mind, it's the PCE that matters more to the Fed than the CPI. All of this brings me to the Fed and to investors, of course. Not to mention that this is the last CPI report the US consumers would see, like I've said multiple times already, before the November elections. Not an ideal print if you are Kamala Harris, because you don't want to go into the election being part of the administration that actually gave a hotter than expected inflation report. So Not ideal news. I'm not saying it will change the election outcome, but it's not particularly great. As you know, the Fed made a monumental decision, but this is not a political show. This is a finance show, so we're going to stick to finance. As you know, and because we stick to finance, as you know, the Fed made a monumental decision of a 50 basis point rate cut, a decision that reverberated across the world, and one that delighted investors, surprised investors, and basically surprised investors to the upside. And the markets have never, they've never been more happier. The latest inflation report has sprung up an interesting debate of whether the Fed will go for consecutive 25 basis point, just one 25 basis point, or the more extreme prediction, which is one and done. And this was actually said by an eminent investor, Ed Yardeni of Yardeni Research, who came on CNBC. I was following his interview, and he said one and done, as in no more rate cuts. So that's pretty much in the extreme camp, I would say. So the question is whether it is two consecutive 25 basis point cuts, November, December, one 25 basis point cut for the rest of the year. So it could be November or December, or the more extreme case, one and done, in which case November, December, unchanged. Let's see. As things stand, according to the CME Fed Watch tool, the odds of a 25 basis point rate cut in November are at 89.5%, with the remaining 10.5% being the probability of a no cut in the November meeting. So you had 89.5% in the odds. The odds of a 25 basis point rate cut in November, pretty high. 89.5%. So that's basically what the current odds are. I still haven't got. We're not talking about December. We're talking about the November meeting. Okay. There are reasons to support both scenarios, not the one and done scenario, but the two consecutive 25 basis point rate cut, and then one either in November or December. There are reasons. So here are the reasons. The strong jobs report, which we got 2 weeks back, along with the sticky inflation, do lend support for the Fed to do nothing in November and defer the 25 basis point rate cut to December. At the same time, given that the PCE is likely to come in cooler thanks to PPI, and the fact that last week we got some key labor data which showed that the number of Americans who filed for initial jobless benefits rose to the highest level in more than a year last week. So we did get some key labor data that suggested that labor data was weakening. And while the devastating Hurricane Helene could have contributed to the initial jobless benefits, the high number of initial jobless benefits, it does go against whatever the jobs report was suggesting. And given the fact that there is continued weakness in the labor market, at least from the Fed's perspective, it does give ammunition to the Fed to undertake yet another 25 basis point rate cut in November. And then, to top it all, we have the earnings season, which officially kicked off on Friday via the big banks. And the message that we are getting from the likes of JP Morgan, more specifically from JP Morgan's earnings numbers, are that the US economy may have already achieved the elusive soft landing. Remember, soft landing, aka Narnia, right? And nobody has seen this before, but apparently we've already achieved it in the US. And basically it means lower inflation and healthy growth. According to JP Morgan executives, that's exactly, in fact, the exact words from from JP Morgan CFO Jeremy Barnum. The exact phrase was, he even used the phrase soft landing during the earnings call. And his exact words were, these results are, and I'm reading it off from the earnings report here, these results are consistent with the soft landing. That's pretty consistent with this kind of Goldilocks economic situation. So, hey, he even said it, even came out and said it. Jamie Dimon, CEO of JP Morgan, was not so particularly positive about it, but CFO Jeremy Barnum clearly mentioned that the US economy may have achieved the elusive soft landing. The comments were made on the back of what the JP Morgan executives are seeing, which is an environment where consumers continue to spend and big businesses remain confident. So when you combine a confident consumer with a confident business environment, the situation you get is the elusive soft landing. And that's exactly what JP Morgan executives are saying, and which led them to say the whisper phrase called soft landing. It was not all good news, though. JP Morgan did see its deposits shrink, and they are expecting higher loan losses from its credit card arm, which shows that consumers do feel increasingly stretched. And the very sad part is that when you combine the observations from both JP Morgan and Wells Fargo, you'll see, which also reported on Friday, by the way, you'll see that it is the US consumer on the lower income or wealth scale who is feeling stretched. And it's really, really incredibly sad. There is a wealth inequality, and it's the lower wealth and lower income category that is feeling the pain. Not exactly a great sign once again for Kamala Harris heading into the US elections next month. I also have to note here that despite bullish comments from banks, both JP Morgan and Wells Fargo saw their overall profits, Q3 profits, tumble. So again, not exactly, it's a mixed report from the banks. However, the environment that they seem to see suggests that the soft landing may have already achieved. Bottom line, just to wrap it all up, I do think there's a lot of good news when it comes to the economy, even if inflation came in hotter than expected. I would wait for the PCE number to come out before jumping to any concrete conclusions. But based on everything I've seen, I would expect the PCE number to be low, which will be a solid excuse for the Fed to undertake the 25 basis point rate cut in November. Having said that, as far as the US markets are concerned, would I put fresh money into them? Absolutely not. The short answer is no. We are heading into an incredibly volatile environment on account of the elections on November 5th. And while the markets have ignored the election noise all this while, they are on a 5-week win streak right now, as I've said before. That is unlikely to be the case going forward. S&P 500's forward PE stands at 29.4 times, which is insanely high given the uncertainties that await us. And now that earnings season is upon us again, investors have to be stock specific, in my opinion. This is the scenario, ladies and gentlemen. The markets are priced for perfection. The Mag 7, especially Nvidia, is back in style again, and there is uncertainty all around. Not exactly the kind of environment I would throw money into. Sip of water time. We're going to head to Doctor Goes Home, because that's the end of Doctor's Weekly Snapshot. The first segment, we are going to head into the Doctor Goes Home. More central bank news awaits you in about 2 seconds. Right, sip of water done. We are in Doctor Goes Home. I like this. No music needed. Video editing takes much faster because clearly I've given a signal to myself. Anyway, welcome to Doctor Goes Home segment. Like I said, ever since I'm recording this now on YouTube, I can't tell you. Sometimes I feel, when I record, I'm thinking to myself, oh my God, this is a pretty goofy thing that I'm doing. But hey, as long as you guys enjoy it, you guys have given me the love. Fantastic. Anyway, moving now from US to India. Last week was when the RBI, and again from the Fed to the RBI, last week was when the Reserve Bank of India's New Look Monetary Policy Committee had its policy meeting. I say new look since we now have 3 new external members on the MPC. The outcome was largely unsurprising. The committee left key rates unchanged, with the repo rate continuing to be at 6.5%, making it the 10th consecutive meeting where the rate has been left unchanged. However, despite keeping rates unchanged, the Monetary Policy Committee did change its stance from withdrawal of accommodation to neutral, offering the first signal that it believes that the inflation fight is in its final stages. Now, chance for me to put on my metaphorical hat of academia, picture academia written here, to explain what is withdrawal of accommodation, what is neutral. Put simply, withdrawal of accommodation stance means a position where the RBI makes money less available to keep a check on prices, less easily available. A neutral stance, on the other hand, means that monetary policy is neither trying to speed up nor slow down spending. So from restricting spending, you have now reached a place where there is neither restriction nor free will to spend money. So it's neither easily available nor less easily available, kind of in the middle ground. But it's a great, so the pendulum is now swung here. It's now bang in center. Moment it goes here, that means it's easily available to spend. Money is available to spend from the central bank. Okay, so we went from withdrawal of accommodation, which means money available is less for spending from the central bank, to it's neither speeding up nor slowing down. So we're exactly called a neutral stance, exactly as the word phrase. Right, the hat goes back off, investor hat back on. The change in stance is the first in nearly 2.5 years and sends a clear signal that the RBI believes that inflation is moderating and that it is starting to consider opening the doors for a rate cut. The odds of a rate cut from Reserve Bank of India have substantially increased in recent months, and it's not because the Fed has done it. Gone are the days when the Fed does it, we have to do it. Nope. Gone. It's not because the Fed has done it. Headline inflation has substantially fallen off. Remember, it was 5.1%. Inflation was 5.1% in India in June. It then went to 3.6 in July and 3.7% in August, well within the RBI's target range of 2 to 6%. And the July and August inflation is in fact below the midpoint of 4%, which is if you want to call RBI's absolute target, just like the Fed has 2% as its absolute target, we have 4%. So inflation in July and August has been below the RBI's absolute target as well. Having said that, there are a few more things that need to fall in place before the central bank can focus on cutting rates. First, food inflation. September inflation is expected to rise again due to an upturn in food prices, although it is expected to ease by the fourth quarter of FY25. And when I say the fourth quarter of FY25, I mean Jan to March 2025. Yeah. So not for the next 3 months, beyond. By the time we get to 2025, the first 3 months of 2025, food inflation is expected or is projected to slow down. And this is because we had strong Kharif crop arrivals and we had a wonderful Rabi season. Rabi season. Apologies for that mess up. Positive Rabi season on account of strong monsoons. Key crop sowing has been higher than last year, and as such, food security is more promising thanks to sufficient buffer stocks. However, until a softening of food inflation actually materializes, the battle against inflation will continue. We cannot say with certainty. Okay, remember I told you the one source that has been the primary driver of inflation in India has been the food inflation. And because we can say we can do absolutely nothing about it we can at least we know, but it's very difficult to control food inflation given the fact that the global factors playing a major role as well. So it's expected to cool down. Food inflation is expected to cool down by the fourth quarter of FY25, but we are far from certain. However, should it materialize, then we can say the battle against inflation is done. Remember, like I said, it's projections, not actual outcomes. So food inflation was the first category that needs to be right, only for us to say, rate cut, okay, time for rate cut, battle against inflation is done, etc., etc., etc. Second category is the geopolitical tensions in the Middle East, which has substantially increased, which have substantially increased in recent weeks, and it has also subsequently increased the odds of crude oil and metal prices skyrocketing. This is of particular concern to India, because especially since we import more than 85% of crude oil for our domestic purposes. This is yet another risk factor that the RBI needs to consider before it can initiate rate cuts. The latest Monetary Policy Committee meeting factored in these items, and as such, their inflation projections are as follows. FY25 CPI inflation FY25 is projected to be 4.5%. Even in the first quarter of FY26, which is April, May, June of 2025, April, May, June of 2025, inflation is only projected to be at 4.3%. Close, but not close enough. And this is because they have to factor in not just the food inflation, but also rising geopolitical tensions. Now, when I say 4.3% by June of 2025, you would clearly say, well, wait a second, we're not at the RBI's target rate of 4%. Why should we initiate rate cut? Before you think that rate cuts are no way close to coming to fruition because all these numbers I threw at you, it's not the case at all. Inflation may be projected to be higher than 4% by June of 2025, but if you notice, the RBI's inflation projections puts inflation very much in the target range going forward, right? 4.3% is still within 2 to 6%, and it's closer to the midpoint of 4%, yeah? And remember, the Fed didn't initiate rate cuts because inflation was 2% to the dot, right? It's nowhere close. We've not seen 2% to the dot. It was heading towards the target, and there was a labor market problem, and that led Fed to rate cuts. It's more the trajectory than the magnitude of inflation that plays a major role in central banks' decisions on interest rates. Not to mention, it's all about balancing the growth as well. To that end, there was a lot of positives to take from the latest MPC meeting. The committee emphasized that the outlook for domestic growth remains resilient as private consumption and investment remain strong. As such, despite the possibility of inflation rising in the short term, it is not at the expense of growth. And it is because of this balanced inflation growth dynamics, something mentioned in the MPC meeting minutes, that the RBI actually decided to change its stance in the first place. So remember the rate cuts repo rate might have been left unchanged at 6.5%, However, the stance has changed from withdrawal of accommodation to neutral. So it's now a more we are reaching to that more friendlier stance when it comes to spending money. Bottom line, inflation is heading in the right direction, guys. No doubt about it. But I understand why the Monetary Policy Committee was reluctant to initiate rate cuts at this stage. There are external factors such as geopolitical risks, which do remain elevated. So, undertaking a rate cut at this point in time may not have been the best idea. But there is no doubt in my mind that a rate cut is coming. In fact, I have to admit, I believe that it is coming in much earlier than even I anticipated. I didn't anticipate it well into 2025, probably around the mark of April to June quarter, so the Q1 of FY26. However, I think we're getting it much sooner than that, 100%. Okay, well, you can never be 100% when it comes to inflation. Remember, they're projections and not outcomes. So, but I do believe that it is going to come in much earlier than what I told you guys in previous shows. Like, oh, don't think about rate cuts; they're not coming. No, my projections have been wrong. I think inflation is done. I think the central bank has done really well, and inflation is moderating at a much faster rate than what I told you guys before. The change in stance was the first step, and if RBI's projections turn out to be true, then it's only a matter of time before they do undertake a cut. In the meantime, the lack of rate cut is not affecting India's growth story at all. The temporary tactical trade by foreign institutional investors that you saw a couple of weeks back, where they allocated money from India to China because of some news driven by their, they gave some press conference, so you could see the FI outflows from India to China. That's something purely news driven, in my opinion, and not something structural at all. In the long term, the India growth story remains firmly intact, and the RBI's shift in stance is proof of that. On that note, we're heading to Dr. Dissects. Right. Pretty long one, this one. Yeah. Oh, 27 minutes. Not bad. I hope you guys are already... Are you guys awake? Hope you guys are awake. We're last segment, guys. Last segment. And this segment is extremely, hopefully would be a lot of fun for me to discuss, because it's everybody's favorite stock that is going to get mentioned in Dr. Dissects. And the stock is nothing but Nvidia, ticker NVDA. It's making a debut. It's making its debut on Dr. Dissects. About time, isn't it? I think I've touched upon Nvidia in the past, but not really dissected it. Okay. First things first, what you got to understand. Nvidia had a blowout second quarter. Okay. Now, Nvidia's second quarter results, especially the 155% year-over-year growth seen in the company's data center division, confirmed what its fellow sensational six members, a phrase I proudly coined, and that includes Amazon, Apple, Meta Platforms, Alphabet, Microsoft, and Nvidia, of course. So the fellow sensational six members said during their respective earnings call, the rate of AI spending is not going to slow down anytime soon. The cloud service providers accounted for approximately 45% of Nvidia's data center revenues. And even as many of them wait for Nvidia's next generation architecture, Blackwell, which the company plans to ship only by the fourth quarter, for now, its existing architecture, the Hopper architecture, is more than enough for these cloud service providers, as none of them want to put off their AI spend until we get Blackwell. By the way, Blackwell has already started being shipped, and Nvidia CEO Jensen Huang, actually, I think it was last week, he came on CNBC, and his exact words were, demand for demand for Blackwell has been insane. His words, not mine. Okay, he's already said it. I think it was a couple of weeks back, so he's already said that. So, in addition to the usual suspects who love to spend on AI, one area in particular which showed considerable growth during the current quarter of Nvidia was sovereign AI. Sovereign AI has not been discussed by a lot of people. Everybody's too focused on Microsoft and Amazon and Meta and Alphabet and so on. Nobody's really talking about sovereign AI. Sovereign AI is going forward. It has a big role to play, and I'm talking about nations using their own citizens' data and leveraging it for their own AI initiatives. As the AI revolution moves up a gear, data privacy and security could be paramount, not just for organizations, but for entire nations. It's a development which NVIDIA management is already starting to observe. During this most recent earnings call, management did provide an example of how Japan's National Institute of Advanced Industrial Science and Technology has partnered with the company to build its AI driven supercomputer. The company now expects sovereign AI to already hit low double digit billions this year. In my opinion, the potential for this segment is absolutely massive. As the saying goes, data is the new oil, and Nvidia's management is unsurprisingly seeing that countries are considering their data to be a national resource and are therefore building their own infrastructure in order to have their own digital intelligence. These are all phrases from the earnings calls of Nvidia. I'm not making this information out of thin air. This is actually happening. The US government has also started the process of geofencing the country's AI tech for strategic purposes and for ensuring AI safety. For instance, the US Department of Commerce's AI Safety Institute has signed agreements with the likes of Anthropic and OpenAI to collaborate on AI safety research, testing, and evaluation. According to these agreements, the AI Safety Institute will have first access to the major new AI models from these companies prior to their public release. Based on this development, the idea of nations funding their own AI startups in the future based on the data within the said nations is not far-fetched at all. The enterprise AI wave, as NVIDIA management calls it, has already started. But sovereign AI, and I can't believe not a lot of people are talking about it, sovereign AI is one area that has the potential to really accelerate the AI revolution. And based on current evidence, NVIDIA and its Blackwell architecture stands to be a major beneficiary of this trend. Now, NVIDIA is AI, right? Everybody's talking about AI, and NVIDIA. When they talk about NVIDIA, they talk about AI. NVIDIA, they talk about chips for data center business. Did you know that NVIDIA also has other segments, not just data center business? And to be honest with you, it's high time that investors stop ignoring those segments, as far as I'm concerned. I mean, it's like, okay, fine, I get it. Nvidia data center business drives majority of the revenue, but that does not mean that the segment including gaming should be ignored. I mean, one division of the company which is actually slowly gaining pace and momentum is automotive. The company's automotive and robotics segment in the most recent quarter generated $346 million in revenue, an impressive growth of 37% year over year. It also translates to a quarter-over-quarter growth of 5%. The growth was primarily driven by ramps in self-driving platforms and a surge in demand for AI cockpit solutions. As autonomous vehicles become the next battleground, anyone saw Tesla's Cybercab event? What do you guys think about it? Do let me know in the comments section. I thought whoever said it was an Uber killer, and that's Elon Musk. I mean, nobody else other than Elon Musk said it. He called it Cybercab will be Tesla's robotaxi would be an Uber killer. Doesn't look like it. But anyway, I'm not going to talk much about the Tesla Cybercab. I'll talk about in another segment, not today. But as autonomous vehicles become the next battleground, with major automakers, including Tesla, focusing their attention towards building robotaxis, NVIDIA's automotive business could be a major beneficiary in the coming years. During the most recent earnings call, management did touch upon this by confirming that automakers developing autonomous vehicle technology are all using NVIDIA in their data centers. Management expects the automotive segment to be a multi-billion-dollar business and attributes this to the potential surge in demand for computing power from next-gen AV models. They're certainly not wrong on that front either. I mean, when I talked about Uber on episode 99, I mentioned at length about the future of autonomous vehicles and how the growth in this market was going to be a major catalyst for Uber and why its AV partnership with BYD is only the start. Furthermore, I also mentioned that according to Fortune Business Insights, the global AV market size is expected to surge to $13.6 trillion by 2030, which translates to a CAGR of 32.3%. And NVIDIA could be a major beneficiary of this revolution, in my opinion. NVIDIA's advanced driver assistance platform drives latest version. It's called Thor. Don't ask. Yep, it is called Thor, which was launched in March this year, has been widely adopted by major automakers who have AV ambitions. Major Chinese automakers such as BYD, Xpeng, Wabi, VRide have all adopted Thor, which integrates the company's Blackwell architecture. Li Auto and Zeekr have also announced that their AV roadmap will also be built on the Thor platform. The AV revolution in China is well ahead of the US, and companies such as BYD are continuing to spend billions towards autonomous driving. The Chinese AV market, according to Research and Markets, is expected to hit $31.6 billion by 2030 at a CAGR of 21.7%. And with the Chinese players also harboring European ambitions, the growth potential for AVs, despite the tariffs, is huge, in my opinion. Today, Nvidia may be synonymous with AI, but that does not mean that investors should discount its other divisions, especially automotive, which is primed to be a major catalyst for the company in the future. So we talked about AI. We talked about we talked about AI. We talked about autonomous vehicles. As I take my notebook, because when I take my notebook, it's valuation time. Company now expects Q3 revenues to come in at $32.5 billion plus or minus 2%. The high end of this guidance would put Q3 revenues at $33.1 billion. So if you add 32.5%, 32.5, 2%, you add another 2% to it, you get about 33.1. Okay, 33.1 Q3 revenues, 33.1 billion. A year-over-year growth of 83.1% and a quarter-over-quarter growth of 10.2%, which would be a deceleration from the previous two quarters. In Q2, it was 15.3% quarter-over-quarter growth, and in 17.8% quarter-over-quarter growth was in Q1. Q3 gross margins are projected to come in at 75%. So you have gross margins, Q3, 75%. Okay, 75% Q3 gross margins. My handwriting could be worse than this. I hope it's not. I have assumed Q3 margins of 75%, which results in Q3 gross profits. Q3 gross profits. Q3 gross profits of $24.8 billion. Okay, $24.8 billion. Non-GAAP operating expenses are projected to come in at $3 billion, and other income is expected to be about $350 million. I've also assumed interest income to be the same as Q3, which is $383 million. The company assumes non-GAAP tax rates for the third quarter to be 17% plus or minus 1%. I've assumed Q3 tax rate to be 16%. If you take it all together, net income for third quarter after taxes would be, so net income Q3 would be 18.93 billion. Net income Q3 18.93 billion. 18.93 billion. The weighted average shares used to calculate the diluted EPS stands at 24.85 billion, which results in a projected diluted EPS Q3 76 cents. So much better with video now. Diluted EPS Q3 76 cents. Since the AI revolution began back in 2023, on average, the company has registered quarter-over-quarter growth, Q by Q growth of 29.43%. If you remove the second quarter of FY23, where Nvidia registered a whopping quarter-over-quarter growth of 87.9%, outlier in my opinion, the average drops to 19.7%, a more reasonable estimate for Q4 revenue growth. So 19.7% is what I estimate Q4 revenue growth to be. Okay, and that's quarter over quarter. So 19.7% Q4 earnings growth quarter over quarter. At that rate, company's Q4 revenues would be projected to come in at 39.6 billion. Q4 projected revenues, 39.6 billion. I've assumed Q4 gross margins should be 74%, a slight reduction from Q3 due to the production ramp of Blackwell. That results in Q4 gross profits of 29.3 billion. Q4 gross profits projected 29.3. Q4 gross profits projected 29.3 billion. The company expects full year operating expenses to grow in the mid to upper 40% range. I have assumed the growth rate to be 45%, which would result in FY24 operating expenses of $11.3 billion. Including Q3 projections, Total operating expenses at the end of third quarter are projected to be 8.3 billion, which implies Q4 non-operating expenses would be $3 billion. I've kept my assumptions for interest and other income for Q4 to be the same as Q3, which are 383 million and 350 million respectively. I've assumed effective tax rate for Q4 to be 16%. If you take it all together, guys, Q4 net income after taxes is projected to come in at 22.7 billion. 22.7 billion. Q4 net income after taxes, 22.7 billion. Weighted average shares used to calculate diluted EPS stands at 24.85 billion. So Q4 diluted EPS is projected to be 91 cents. Q4 diluted EPS 91 cents. Which would, if you, so 91 cents for Q4. You combine everything, you get FY24 diluted EPS would come in at 2.96. FY24 diluted EPS $2.96. The company, according to LSEG data, currently trades at a forward price to earnings of 34.2, similar to its historical 10-year median multiple. Given the potential growth not just in its data center but also in its other divisions such as automotive, get carried away, it's automotive. I've assumed a higher multiple of 35.6, which is the company's 2-year historical median multiple. The company, according to Seeking Alpha, currently trades at a forward price to earnings to growth ratio of 1.15, significantly below its 5-year average of 2.09, and even below the sector median of 1.93. However, I do believe that its current ratio of 1.15 is justifiable given the multitude of catalysts for its earnings growth. As such, I've assumed the multiple for my calculations and a forward PE of 35.6. The projected earnings growth comes to 30.96%. At this earnings growth, FY26 EPS comes in at 3.88. Simple story, guys. You put 35.6, you take the next page, 35.6 PE, multiplied by 3.88 EPS, 35.6 PE multiplied by 3.88 EPS gives you a price target of 138. Ignore everything else that I've just blabbed. That's the price target I get from my valuation. It would be all-time highs, guys, if it were to hit the figure, but sadly, this is around the levels where it's currently trading. It's finished the week at 134, 135. So it would be a new all-time high anyway, which 135 was already a new all-time high. 138 would be yet another new all-time high. But given the momentum seen in the stock, don't be surprised if it blows past my target. Still, from a fundamental perspective, I think the stock is currently priced for perfection. I would be worried if this is not investment advice. I don't give investment advice. It's my suggestion. I would not be putting new money, fresh money into it at this current levels. Let's talk about risk factors now. Main risk factor is the slowing sequential growth in revenues and gross margins. While there were valid reasons such as inventory provisions for low-yielding Blackwell material for the decline in this quarter, whether the company can reverse its growth trajectory is an area that investors should watch out for. Furthermore, the rise in competition is also a headwind to growth, and at what rate competitors like AMD are grabbing market share will also be key for Nvidia's future growth. Bottom line, Nvidia had yet another blowout quarter, with guidance also nearly beating expectations. The growth expectations of this company has been stratospheric in recent times, that the magnitude of the beat is what drives the stock price. As such, the stock tanked post its earnings release since the magnitude didn't match investors' already lofty expectations. But all of that is in the past, because the stock since then, ever since CEO Jensen Huang came on CNBC a couple of weeks ago and said the demand for Blackwell has been insane, the stock has absolutely rocketed to new all-time highs. So post-earnings, it might have tanked, but that is that is way in the past as far as Nvidia is concerned. Right now, it's currently trading at near all-time highs of $135. If you really dig the quarterly report a bit deeper, one would see that it's a company that is firing on all cylinders. The company's data center business confirmed what the likes of Microsoft and Alphabet have been babbling about, which is that the AI spend is here to stay and that Nvidia stands to be a major beneficiary of this development. At the same time, the rise of sovereign AI is an area that investors need to pay attention. They really need to pay attention, given that it has the potential to be a substantial growth driver in the coming months. Lastly, the AI revolution should not distract investors from the company's other divisions, especially automotive. I got that one right this time. As automakers pivot towards building autonomous vehicles, the automotive division of Nvidia is set for years, if not decades, of growth. When one really thinks about it, there are two revolutions taking place simultaneously: the much talked about AI revolution and the quiet but significantly important AV revolution, or autonomous vehicle revolution. And Nvidia, in my opinion, is one of those rare companies that stands to benefit from both. As such, despite trading at near all-time highs, one simply cannot ignore the semiconductor giant. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on thestockdoctorpodcast@gmail.com. Thank you once again for listening. Hope you're enjoying the video version of the podcast as well. See you next week for episode 103. Until then, ladies and gentlemen, stay safe and make some money.